All right. So today we are going to talk about further on double entry bookkeeping, continuing from our previous lesson. So in our previous lesson, we talked about the double entry bookkeeping for assets, capital, and liabilities. So we know that when asset increases, we debit it, and when asset decreases, we credit it. When capital increases, we credit it. When liabilities increase, we credit it as well. Okay? And we did a little practice for this double entry bookkeeping. Now we are going to build on that and we are going to further talk about more double entry bookkeeping. So we have another concept, which is inventory. Okay? So first, let's try to understand what inventory is. So this is basically the products you buy to resell. So if you are in trading business, so the things you buy to resell, that's called inventory. We also call it stock, we also call it goods. Sometimes we also call it supplies. But let's say you are a retailer and you are selling t-shirts. You have stock of t-shirts at your store. So this stock of t-shirts, that's called inventory. Okay, so that's your inventory. You have a car as well, you know, for the deliveries or anything, but that car, that's not inventory. That's like, your regular asset. Okay. T-shirts are the asset, is the type of asset that we call inventory. Okay. Let's say there is another business and that's a car dealer. So they are dealing in cars, which means they're buying and selling cars. They have a couple of cars standing at the showroom, right? What kind of cars they're making. Okay. You know, so they have a couple of cars standing at their showroom and they bought these cars because they want to resell them. So these cars is also inventory for this business. Okay. So for our business, our car was not inventory, but for them, it's the part of inventory because we bought it to resell. Okay. So the things that you're trading in, you buy to resell, that's inventory. For inventory, we don't make an inventory account. Rather, we make 4 different accounts, which are sales, sales account, purchases account, sales returns account, and purchase return account. So, sales return is also known as returns inwards. And purchase returns are known as return outwards. So sales, as the name suggests, so when you're making the sales, you're selling your products. So you're going to book that thing, you're going to book the amount in your sales account. When you're purchasing, so remember, we are just talking about the purchases of the inventory of the stock. Okay? Like, for example, when our business was buying t-shirts, so that's purchases. Okay? When we are buying a car, that's not a purchase. Okay? We are not gonna put them in purchase account. We're gonna put them in the assets account. Okay? We're gonna make a separate asset account with the name of vehicle, right? Or car or van, whatever. And then we're gonna put that thing in our asset account. When we are purchasing to resell, like when we're buying t-shirts, so we're going to put them in purchase account. Same is the case with sales. So let's say after a while we decide to sell off our car. When we're doing that sale, we don't call it sale, we call it disposal. Okay? Disposal means we're selling off our asset. But when we are selling our t-shirts, that's sales. Okay. So sales return. Let's say, we sold some of the t-shirts to a customer and then, they didn't like it. So they got it back. So we got our t-shirts back. That's sales return. Purchase return is, you know, when we did the purchases and we returned it to our supplier. That's purchase return. Okay. So, as the name suggests, return inwards means that's the return which is coming to our shop. Okay. So this is return inwards. And if we are returning the goods, we are returning the inventory, as the name suggests, that's going to be returned outwards because that's going out. Okay. We have return inwards and return outwards. The thing is that how we are going to do the double entry bookkeeping for all these four accounts. Like I said, these accounts are basically inventory accounts. These are goods accounts. So we are going to identify, and goods and inventory, these are our assets, right? We know that. These are our assets. So we are going to identify for these accounts, we are going to identify them as assets. Okay? So when I'm doing sales, my inventory is decreasing. Okay? Which means my asset is decreasing. Okay? So sales are increasing, my asset is decreasing. So I'm going to credit it. So sales are always credit. When we do purchases, when we are doing purchases, which means the purchases are increasing. So my asset, which is inventory, is also increasing. So we always debit. So sales account is always credit and purchase account is always debit. Purchase return means we are returning the goods. So the goods are going out from our business. So our stock is decreasing. As my stock is decreasing, it means I'm crediting it. And when I'm doing sales return, it means we sold some of the products and they are back. So my stock is increasing. Okay. If my stock is increasing, it means that's going to be debit. Okay. So quickly, we make 4 account for our inventory. These accounts are sales return. purchase, purchases, and purchase return. Okay? So when we do sales, our inventory decreases. So we credit it. Now, inventory is an asset. Okay? Remember, inventory is an asset. And we're going to see what is happening with our asset. When we do sales, our inventory is decreasing, so we credit it. When we do purchases, our inventory is increasing. Okay? When my inventory is increasing, so I debit it. So sales account is always credit. Purchases account is always debit. Sales return account is opposite of sales. So when we do sales return, our inventory is increasing because I am getting my stock back. And my stock is increasing, so I'm going to debit it. And when I'm doing purchase returns, it means I did purchased some of the stock and now I've returned it. So my inventory is decreasing, so I'm going to credit it. Okay. Sales always credit, purchases always debit. Sales return always debit, purchase return always credit. Okay. Right. Let's try some double entry bookkeeping. Okay. So let's see what happens to these accounts. Goods bought on credit from J Reed. Goods bought on credit. Goods is my inventory, my stock. So account to be debited is going to be purchase account, purchases, and account to be credited is going to be my J Reed account because that's our liability and liability is increasing. Goods sold on credit to B Perkins. Yeah. So goods sold on credit to B Perkins. So when we did the sales, so our stock is decreasing. If my stock is decreasing, it means my sales account is going to be credited. And B Perkins is my receivable. Receivable is an asset. So this asset is increasing. So I'm going to debit B Perkins. Okay. Vans bought on credit from H. Thomas. Now, we are not purchasing goods. We are purchasing a van. So that's going to be an asset account, and we are going to debit van account. Okay? So van account should be debit, and H. Thomas account should be credit. Goods sold, a check being received immediately. So we did the sales account, credit, because stock is decreasing. Okay. And since we received the check, we are going to debit bank account. Goods sold for cash. Sales happening, goods are decreasing, sales account credit, and cash account debit. Because we're receiving the cash, cash is an asset is increasing. Okay. Goods purchased by us, returned to supplier H. Hardy. So we purchased some of the goods and now we returned it. It means this is purchase returns. Purchase returns means my stock is decreasing, right? When we purchased the stock, my stock increased and now I'm returning it back. When I'm returning it back, my stock is decreasing and stock is an asset, so that's going to be credit. Okay. So purchase, return, credit, and H Hardy. H Hardy was my liability because I bought from him on credit. Okay. Now, because I have returned goods to him, it means I'm not going to pay for those goods which I've returned. So my liability is decreasing. And when liability decreases, we debit it. When liability increase, we credit it. And when liability decrease, we debit it. Machinery sold for cash. Now look for the wordings. This is not goods sold. This is not stock sold. This is not inventory sold. This is machinery sold. Okay. So machinery sold means we are selling our asset, and that's called a disposal. That's not sales. That's we call disposal. And we credit the machinery account because machinery is going away. Oh no, our machine is going away. So machinery is credit. That's an asset decreasing. So we credit and getting the cash debit. Goods sold returned to us by customer. Now, customer returned some of the goods to us. We got the goods. So stock increasing. As stock increasing, we're going to debit it. Okay. So sales return debit. And now customer is no more our asset, right? He was a receivable, but now he's not going to pay us, because he returned the goods. So asset decreasing, we're going to credit it. J. Nelson. Goods bought and credit from D. Simpson. We bought some goods. Purchases, debit, stock is increasing. And D. Simpson is a liability. That is credit. Goods we returned to H. Forbes. So we returned some of the goods. Sales return debit. Oh, we return goods, sorry. Because we return, it means that's purchase return. Purchase return, credit, and H. Forbes was a liability. Now a liability is decreasing, so we credit it. Okay. I hope it makes sense. Now the second question is homework. Let's do a question, double entry bookkeeping. All right. So I think I missed the recording, so let's do it again. So started in business with 750 cash. So we debit cash and we credit capital. Bought goods for cash because we're buying goods. So debit purchases, credit cash, because we bought the goods. So purchases are increasing. So purchases debit and cash credit. Okay. Bought goods on credit. So when we bought goods on credit, 320, so purchases are going to be debit because our goods are increasing, but our liability is also increasing because he's F heard. Okay. So F heard credit. Sold goods for cash, 64. So because we got the cash, so cash is an asset and that asset is increasing. So we debit cash and we credit sales. Okay. Return goods to F heard. Now, we bought the goods from F heard. Now we return some of the goods to him. It means our stock is decreasing. When our stock is decreasing, we are going to credit our return outwards. Okay, return goods. So we are going to credit our return outwards, which is our purchase return, and we are going to debit F herd because F herd is no more a liability for at least that 46. Okay, so the entries for this is going to be debit purchase return and credit F herd. Okay. Okay. Bought goods on credit 414 from the Exodus. So because we bought it on credit, so the Exodus is becoming a liability. So we credit it and we debit purchases. Okay. And return goods to the Exodus. Some of the products, some of the goods are returned to him. So he is no more a liability for at least this 31. Okay. So we debit the Exodus with 31 and we credit purchase returns. Okay. Now we have sold goods to B square. So B square is becoming our asset. So debit B square, 82, and credit sales. Now paid F herd account by cash. We paid his account. Okay. Got the cash and we paid him. So cash is going out. Okay. So asset is decreasing for sure. So we are going to credit our cash 274 and we debit F herd because once we paid him, he is no more our liability. It's no more our liability. So we debit it. When liability decreases, we debit it. Okay. B square paid us his account by cash. So he paid us his account by cash, got the cash. Cash is an asset which is increasing. So we debit cash 82 and we credit B square because he is no more our asset. So we credit. Okay. Okay. Let me upload some questions for your homework. So these questions you're going to do for your homework. Thank you very much. See ya.